Let's start with active business income. That's generally the profit your company earns from actually running the business. The first $500,000 of active business income is generally eligible for the small business deduction, creating a lower corporate tax rate and a potential tax deferral when profits are retained in the corporation. That can create flexibility, because money left in the company may be taxed later when you decide how and when to pay it out personally. For many owners, the advantage is timing, not permanent tax savings. Passive income is different. Instead of coming from day-to-day business operations, it usually comes from investments held inside the company. That could include interest, dividends, or capital gains. Passive income inside a corporation is often taxed more heavily than active business income, and capital gains are generally more tax efficient than interest income. So planning isn't only about how much the company earns, it also depends on the kind of return you earn and when that return is realized. Two portfolios with similar values can produce very different tax outcomes if one leans toward interest income and the other leans more toward capital gains. Here's where owners often get caught off guard. Passive income doesn't just affect the tax on the investment income itself. When adjusted aggregate investment income rises above $50,000, access to the small business deduction begins to be reduced. In plain language, earning too much passive income inside the corporation can shrink access to the lower small business tax rate on active business income. That's why this becomes a monitoring issue for owners who are building large corporate investment portfolios over time. One planning tool that may come up is a holding company. At a high level, it's a separate corporation that can sometimes be used alongside your operating company. Holding companies may be used to hold passive assets, support purification planning, and provide creditor protection or estate planning flexibility. That can matter if you're trying to move excess investments out of the operating company or preserve access to valuable tax treatment later on. For example, the lifetime capital gains exemption for qualified small business corporation shares was cited at $1.275 million in the source material. Estate planning matters too, especially when a large part of family wealth is tied up in private company shares. Without planning, private company shares can create tax on death and then additional tax when corporate value is later accessed by heirs. The technical rules can get complex, but the big idea is simple. Estate structure and timing can make a significant difference to what the next generation ultimately receives. Every situation is different, so speak with your tax and legal professionals for advice tailored to your business and family. And if you'd like help understanding how these rules may affect your corporate wealth, estate, or succession plans, contact a wealth advisor at TVH Financial by website tvhfinancial.ca or email financial@tvhgroup.ca to start the conversation.